Ladies and gentlemen, good afternoon and thank you for taking the time to be with us today. My name is Hegreef Khaitan and I am a partner in Khaitan's corporate private equity and M&A practice group. On behalf of the firm, I would like to extend a very warm welcome to each one of you, whether you are in the audience in India or abroad. This is our first webinar on our M&A series of 2023. We've had a fantastic response to the M&A Master Series, and this is the third year of this program. We have had an excellent program in 2023 and have been very pleased with the response again this year from the M&A community in India and abroad. We are very grateful for the interest and support which our clients, associates, and others have shown in this M&A Master Series. Thank you. On this slide is the agenda for today's webinar. In short, the format will be a discussion between our expert panel, followed by a Q&A session with audience questions. We have already received several audience questions, and if you do have questions, please submit them using the facility provided in the webinar portal. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. Also, please note that after the webinar, you will receive a copy of the presentation, summary notes of the key issues discussed, and a link to the recording of this webinar. Today, we will discuss recent trends in private equity M&A. Private equity is and has for some time been a major force in Indian M&A. We are seeing private equity in the majority of M&A transactions we are involved in today. Therefore, it is very important to appreciate the perspective of private equity on Indian M&A in order to have a good understanding of the M&A dynamics and conditions in India. Every person who has registered for this webinar has already received an email with full particulars of the credentials of our panel. So I will not spend much time introducing the panel again and summarizing their experience. Suffice to say that they are all M&A experts with excellent credentials. We are fortunate to have three leading private equity practitioners panel, namely Manisha Girotra, Chief Executive Officer of Moelis & Company, Sahil Bhatia, Managing Director at Bain Private Equity, and a member of the Asia Pacific Private Equity team. Kapil Modi is a Managing Director at the Carlyle Group. In addition, we are joined by my fellow colleagues at Khaitan & Company, Bharat Anand and Akash Chaubey, who are both partners with the Private Equity and M&A Practice Group and are very experienced private equity lawyers. So now let us begin our expert panel discussions. So may I start with you, Manisha? What is your outlook to global growth, and do you expect the US to be in recession? If so, to what extent will India be impacted, considering the global slowdown, especially from a deal-making perspective?
Thank you, Khaitan & Company, for having me on this panel, and thank you, Hagri, for that question. I think, look, it's difficult to say whether the US will go into recession or not, but one thing is very clear, that we are in a very challenging environment. There is a lot of uncertainty. There are a lot of dark clouds. Variables like what happened over the weekend with Silicon Valley Bank will continue to spook the market. Inflation continues unabated, and don't forget, I agree, unlike our economy, which is used to high inflation rates, and our government, our regulators, our Indians are by and large used to 5-6% inflation rates, the US and Europe is not. So they will continue to try and resolve this inflation levels and bring them lower. and to that extent, growth will continue to get compensated. The war continues, and that's sort of, even though the markets discounted it, one always has to remain wary in a situation as sensitive as that. China, even despite opening up, hasn't really shown the growth levels, and it's clear is not going to be able to demonstrate the growth levels it has shown in the past. So as you can see, there's uncertainty all around, and that will of course impact us. Coming to India, while the global headwinds are there, I think what we've done in the last 10 years, we are going to reap the benefits of that. Just the very difficult structural reforms we undertook, GST, RERA, to name a few, will basically put us in a good position. So I'm very confident on India. I think we'll stand out. Till earlier in the year, there was this huge view that India will benefit disproportionately from the flows. I don't agree with that. I don't think we'll benefit disproportionately. And I think because we're so integrated with the world economy, we do need the other economies to lift and rise. So the year will remain volatile for us, but structurally, long term, I'm very positive on India. And to answer your last question, my clients too, my global clients, are also very positive on India. They see it as a very large economy. They see the demographic dividend and how it's going to pay off. They see the whole consumption story. Quarter on quarter, we are seeing volatility in the consumer markets, but the structural trend is towards the positive. I mean, if you just look at a couple of trends, you look at cars. India's car penetration is 3% compared to 16% in China and 70% in the US. Similar statistics are there for the air conditioning market. So I think that every segment you can see that the structural reforms and the demographic dividend will reap us positive benefits. I'm worried on the quarter on quarter. I think there will be volatility, but long term, the strategic investors and the private equity investors like Kapil and Sahil, and I'm sure they'll talk more about it, continue to remain very positive on India.
Oh no, that's a great perspective, Manisha, and also in one way heartening to hear from you, because I think we'll all have a job there.
Coming to you. To add to what Manisha said very quickly, I think, when we're in the market for our fifth Asia fund, and what we've seen in the last, let's call it 5-6 months, is there's just an increased level of questions coming in from LPs on India, right? And they are, there is a higher level of interest. Of course, there's always been, India has, garnered a lot of interest. It's, if I look at the prior fund versus this fund, we've fielded a lot more questions than we typically would on India. And there's like this entire sort of thought process around, listen, can you increase, how much you deploy into India from your fund? So I think even globally, people are, focused on where India can go and are putting capital behind it. So
that's terrific, actually. Great to hear that. So, Kapil, moving to you, a large section of industry observers believe that the growth of private equity in India in the last 10 years or 10-15 years was attributed to the India growth story. This section considers, that the PE industry did not really add operational value to businesses. Do you agree with this view? And how are today's buyout funds in particular approaching value creation for Indian businesses? And does, in your view, PE offer a tremendous alternate, avenue of capital?
Thanks, Agri. Thanks for inviting me to this panel. And I have personally been fortunate to be part of this industry exactly 15 years ago. In March 2008 is when I joined Carlyle. And I've personally seen and experienced and benefited from the multifold growth that has happened in the Indian industry. I would say that the economy has to grow for us to be able to deploy increasing amount of capital. So all of us in various parts of our business have benefited from the economic growth. But if we were unable to add value, our LPs would not be giving us the capital. We cannot deliver the returns that our LPs expect and what we promise to them without adding operational value and driving EBITDA growth and transforming these businesses. And what gives me a lot of pleasure is that we literally act as a bridge in some ways. That at one end, we have these pension funds and to whom we generate better returns than the alternative venues to deploy this capital and hence provide a security to the pensioners out there, and then bring this capital to this country, because we really need a lot of capital for driving our growth. So not only just that we generate returns for our LPs, our companies, when they grow, they provide a lot of employment, they provide better products and services to their consumers, and then they also generate a lot of taxes for our government and fund that. So I think that private equity has emerged as a tremendous avenue of not only capital, but driving this transformation. One of the businesses in the early days that I was associated with was Tirumala Milk Products, and it touched 600,000 farmers. And before Jan Dhan accounts were opened, we ensured that each farmer got paid in their bank account, because we're trying to get cash out of that transaction and make it digital. We were able to implement the second largest SAP transformation, so that accounts were live every day. And hence, in 3.5 years, when we were selling that business, that small business from a Narsarupet village in Guntur district of Andhra Pradesh generated immense interest from two of the largest European dairy players. And we had a good outcome, but I felt great that our 5,000 employees had a great outcome. That business is close to 2 times that size, so the farmers had a great outcome and the consumers had a great product. So I think that operational value add is a necessity in our business.
No, very, very insightful, and I think I have no doubt and personal experience of how private equity has, transformed businesses and created jobs, and is such a large force in the economy in India. So thank you for that.
Hi,
Moving to
may I
you.
just make a quick
Yes,
add
please.
to the point here? I just want to endorse what Kapil said. In my experience, you remember, I just want to talk about the IT services, because everyone talks about how we are the office to the world, and we have demonstrated that. And when I started my career, it was just 3 or 4 IT companies which was supposed to lead the world, which was TCS, Infosys, Wipro. And the small companies, the view was, including of bankers like mine, that these companies will consolidate with the large caps or die. They just can't take on the new global environment. And I think the last 15, 20 years, private equity has demonstrated so much value in the key segment of our country. You look at Hexaware, which we first sold to Bearings, and then we were fortunate to work with Kapil on that, the kind of value addition that Hexaware has done, or Emphasis, and there are multiple other IT services tech companies. In fact, I think private equity has brought in very good professional management. They've been able to attract global talent into this sector, which was very important, professionalize the companies, give them high corporate governance. And today, we are on the map of the world more because of IT services than any other segment, right? The factory to the world still has to be demonstrated, but the office to the world is a long proven fact. And I think private equities played a very, very important role in that segment. So I just wanted to endorse what Kapil said.
No, thank you very much. That's very useful. Coming on this favorite topic of interest rates, Manisha mentioned a little bit about rising interest rates, Sahil, and we all know, leverage plays a very important role in returns for private equity. And with the US increasing interest rates and several other jurisdictions also following suit, cost of capital seems to be going up. Is that a key consideration while you consider deals in India? And are you observing challenges in raising leverage on deals? Do you expect this to impact IIR or MOAC in Indian deals?
Yeah, thanks, I agree, for having me on the panel here. Akash will be intimately aware of something we recently worked on, which which required some leverage, and there are challenges there. But I think from a private equity standpoint, especially in control situations, leverage does play an important role in our return math. If I look at our IC memos over the last 12, 24 months, typically leverage is let's call it 2 to 5% of your returns, right, in terms of IRR that you're solving for. It could be higher depending on which sector and what multiple you're coming in at and how much leverage you have, but just ballpark 2 to 5%. Of course, in more mature markets, it could be even higher contributor. Like our team in Japan, if you look at what they do, there's a lot of returns that are juiced out of from a leverage standpoint. But if I just look at Asia versus US and Europe, I think US and Europe clearly has been very tough. I think these markets are pretty much, I would say, closed for business from a leverage or even a bond market standpoint. I think especially with what's happened over the weekend, I think it's probably going to get even more tougher. The Asian markets thus far have actually been open, at least on the loan side, not on the bond side. But what we've seen is while you were able to do, let's say 5.5, 6 turns in 2021 in a deal, I think that number is now down to 3.5 to 4 turns. And of course, Kapil can add to this in terms of what he's seeing. But at least what we are seeing is there is a reduction in the number of turns you can get. And on the other end, while the spreads may have gone up slightly, you're looking at 4.5% type spreads, but the SOFR itself has gone up from what used to be under 2 to 4.5%, right? So overall cost of leverage has gone up meaningfully, and you're getting lower turns. So the short answer to your question is yes, it does impact IRR and private equity's ability to pay, especially in situations where you have a meaningful amount of leverage. And I think at least given what we're seeing, this is probably going to be around for some time to come, and so it could impact deal flow, deal making, and certainty around what private equity can pay.
No, thank you for that sharing that candid view, and we have to be realistic of where we are and sort of temper expectations accordingly. So Bharat, let's move to another topic and take private, and let's talk about taking private in India. We all know is extremely challenging. Squeezing out minority is close to impossible. So how do you really price good businesses with minority, which prima facie cannot be taken out?
Thank you for the question, Haigreve. Let me unpack that slightly. If you have an activist minority, what is critical is not purely a question of price, but actually, what is good deal governance. And I think good deal governance can stand you in good stead, whether you are before a legal court or you're in the court of public opinion, on the cover page of the Economic Times, for example. So, if you think about situations that all of us have been involved in on a day-to-day basis, where say you have a company where investors have a significant majority, the investors have say 80%, there's a founder there with 10 to 15%, management has 5%, and investors say, look, we want to exit, and let's exit to a strategic, let's exit to someone in the same sector, a competitor, but the founder says that, look, it's premature, it's going to kill my culture, it's going to kill the uniqueness. You could have the best contract in the world. You could have a hardwired drag with the ability to appoint your own chartered accountant and calculate FMV, fair market value, but views on what that fair market value is can differ considerably. The founder will always argue there is a hidden patent or some revenue curve coming up the chain, which is going to be absolutely blockbuster. And the situation gets contentious, and you can then foresee the pressure if you're an investor director sitting on the board, with fiduciary duties, with obligations to act in the best interest of the company and not a private purpose. Sometimes investors come with liquidation preference and convertibles, and they demand a control premium and differential pricing. So, so I think having a good governance process is important. And if we just, look back at what SEBI's done a couple of weeks ago with all their consultation papers, right? I mean, they're now looking at regulating shareholder agreements at holdcos, and they're looking at regulating how asset transfers and slump sales takes place through listed companies. What's the focus there? The focus there is not on price. The focus there again is proper disclosure, forcing the board to come up with a rationale, and going to shareholders for ultimate, corporate democracy. So, to respond to your question, I think price is obviously an important factor. Everybody's making investments for economic returns. But good process and good deal governance cannot be overlooked. Getting independent directors involved early in a transaction process is important, because independent directors ensure that you have independent advisors, and therefore conflicted people aren't appointing conflicted people, and that's a great insurance to give to minority. And ultimately asking yourself, how will this process look, in hindsight? So obviously can't ignore price, but I think process.
Well, thank you for that. Well, Manisha, you would have seen how people have been sort of pricing a minority sitting there and inability to take out minority, I guess, in deal pricing.
Yeah, I think it's a huge issue in India, right? I agree, as you rightly said, and it impacts valuation, it impacts deal closure. In fact, the current transaction that we are working on fell out exactly for this reason, that the view that the strategic took is that in India to basically take out the minorities is either impossible or just too expensive. So I think it does tend to be a roadblocker. Private equity actually has done quite well in actually taking companies buying out listed companies. They've got comfortable around this pretty quickly, and a lot of them have demonstrated that they're happy to basically acquire listed companies, because I think they've also managed to see exits in listed companies. But despite, I mean, the initial positive initiatives that private equity has taken, I think generally this is a big roadblocker in Indian transactions, and a lot more needs to be done on it, as Bharat said, to get more and more strategics into it. And my view is the US and European strategics will come in much higher numbers and stakes and deal sizes if we were able to resolve this issue.
I think very useful feedback, and I think from what I know, the regulator is actually looking at revamping the delisting regulations. They're cognizant that we need a good exit regime, so hopefully we'll have something more workable and practicable. Akash, moving to you, let's look at the regulatory side. So we have witnessed a slate of regulatory reforms over the last 12 to 14 months. We have seen some challenges, especially for investments from land bordering jurisdictions. Having said this, the government of India is very focused on the Make in India approach, and also to make India the destination for foreign investment. Is there one regulatory change that you'd like to see for growth of Indian payments? And if that be the case, what would that be?
Thank you, I agree. Difficult question. And as a fellow practitioner, you probably know that there's a long list of changes that we would like to see. Whether it is the necessity to have regulatory clarity on Press Note 3 thresholds and its operating principles. I would say clarity on pooling of investments from certain non-FATF compliance jurisdictions, or for that matter, clarity on just promoter classification rules for private equity-backed companies. However, I would take a cue from what the discussion you just had with Sahil. A lot has changed since India opened its economy for foreign investment in the early 90s. India's traversed from the license Raj era to the FARA regime to today's almost 100% liberalized regime. We used to have a handful of companies, of quality companies, I will say back in 2002, 2007, and 8. And every private equity firm was looking at investing in those companies. And just look where we are now today. Likewise, our market and economy has also deepened enormously. I mean, we had one unicorn every 11th day in 2021, if I'm not mistaken. And now the data may be slightly misplaced, but the point is that we've matured significantly as a market and as an economy. And my apologies for this prologue, but it is critical for us to appreciate that one change that I definitely would personally like to see, and that would be a more stable and clear laws permitting leverage buyouts. And when I say this, as we, Sahil just pointed out, that leverage plays far too important role in a company's life cycle. We all know that the cost of equity is a lot more than the cost of debt. Now, a classic private equity investment requires better use of capital structure to optimize returns, not only for the investors, but for all stakeholders. Now, look at what's happening today. Today, Indian banks cannot lend to acquire shares. External commercial borrowings cannot be used for acquisition financing, and then we have on top of it all the entire thin capitalization norms, which anyway restrict the deductibility, tax deductibility of interest payments. So while there is a bias, I would say, against the use of leverage, and I agree, there's a possibility of misuse or perhaps abuse. Let's take, you have lesser cushion to manage problems in the future, and over reliance of debt. And you can't just take away the fact that the world of finance is increasingly getting more complex. But I would say there are several upsides as well. And a lot of issues can be tackled by the regulations. Reserve Bank of India is a phenomenal regulator. We've witnessed it time and again, and we witnessed its far-sightedness on several occasions. We don't have to go much back in time. So I do believe that clear and stable guidelines permitting acquisition financing will definitely deepen private equity investment, will enhance returns, and as we just discussed, it will create more value in the long run for the entire economy.
No, I think that's fantastic input, Akash, because I recently heard one banker, a leading banker, actually say this, that those times where bank lending to capital markets was barred, is it now time to get over and abolish those restrictions? We have a very great regulator. We have deep banking system, and we are artificially inflating our cost of capital with all of these restrictions. And the same capital coming through NBFC route or coming through FPI route, and then doing these acquisitions, is it really time to abolish it? And it's gotten far too complex, where if you're really looking at a leveraged buyout, are you looking at a foreign level with security? Are you looking at FPI? Are you looking at NBFC? Or can you do a business acquisition through bank finance? It's become just so complex that this banker actually said we should get over all of these restrictions. So great input. And I think that could go a long way for private equity. So let's move to another topic, and let's talk about expectations around PE valuations. And Manisha, if I can come to you, SPACs are almost dead. Public markets are slowing down. So it appears that PE is in the driver's seat now. So with this enormous sort of dry power available for PE, the war for quality assets seem to be rising. This can have an impact on expectations from founders and valuations for the PE industry. How do you navigate conversations with founders, in an environment like this?
That's actually a great question. And, there is a real dilemma here, because I agree in the first part, as we discussed, we're sort of shining out as a beacon of hope and growth in this doom and gloom environment in India. And that's what we position it to our corporate clients, saying that, look, India's in a sweet spot, and, everything is looking good. And, there are certain segments which are really shining out. So one part is that, and then we also mentioned things like private equity has $1 trillion of dry powder lying, leverage from private credit such as Apollo, Blackstone is coming back. It may be expensive, as Sahil said, but it is available. So one side we present that positive story. The other side is the realities which you just mentioned, which is that private equity can only make its returns when it gets leverage. And because of our rules, which Akash articulated so well, we really are dependent on the global firms. Now, the global banks are, given what's happening in Europe and US, going to continue to be constrained. Interest rates are rising, so leverage is going to continue to be expensive. You heard Sahil say how the leverage levels have fallen down. So for private equity to make its returns in that environment, the valuations have to stack up. So it's a bit of a dilemma, and I think the answer, in fact, lies in your question, which is that really capital will now flow to quality assets only. It's not only about, it's actually excluding. It's not that the not so good assets will get outcomes at lower valuations. I think they won't get an outcome. It's reached that levels. While quality assets will continue to be fought hard for. We were a cover bidder for a port asset that Bain sold its stake in GM Bakshi, and we lost out to Hapag-Lloyd, and it was so competitive, and right till the end, I think it traded finally at some 14 times EBITDA. Sahil can correct me, but basically the point being that for quality assets, and this was a war between two strategics, not even private equity. For quality assets, the outcome will continue to be good and positive, just because people want to play India, but they want to play it through the assets which have high governance, high growth, and the ones that don't have that, and we're seeing that in our portfolio too of the company that we are assisting on exits, we're actually just not seeing an outcome, because in an environment like this, whether it's private equity or strategic, they don't want to make a bet on an asset which is even seen as semi not clean, so to use the word, or where the growth has not seemed to be tried and tested. Gone are the 2021 days where you could just tick the box on India, or just say we have a great idea with limited execution ability, and you would have an outcome from one private equity or venture capital or strategic. That's gone. Not a bad outcome, because at the end of the day, these are the quality assets which will give you the best returns, and put India on the map. But short term, as I said before, there is a lot of pain, and private equity continues to dominate. So Sahil and Kapil can pick what they want, right? What they want and what price they want.
I wish it was so easy, but I would echo what Manisha said, that there is a lot of desire to invest in India across global firms, and there's a lot of demand for high quality assets with high quality management teams. In fact, we go back to our committee, and our committees regularly ask, why are we the most suitable legit owners for the business? The business that Manisha helped us acquire, Hexaver, it was a very competitive environment, and we had to really go deep into our network to see, with Carlyle's global network across the world, US, Europe, and Asia, how much value can we add in terms of our differentiation to be the rightful owners of that business. The business had an excellent management team, very well governed, taken private, one of the few assets with size, scale, great execution. So it had a lot of demand from strategic, from competing PE players, and to emerge as the bidder, winning bidder, you have to pay the highest price. But I think the way we justify that price to our committee, and more importantly to ourselves and to our LPs, and then generate the right return, is by adding tangible value through enhanced revenue growth under our ownership due to our investments in M&A, due to our global network. And that is very critical. So that value creation, the first question that you had asked, has become even more important for high quality assets.
Yeah, I'll just add to that. I think totally echo what Manisha and Kapil are saying. I think when we are having these conversations, I think the first thing, to Kapil's point, I see asks you is, one, what differentiates you in this, in winning this transaction? And actually, that's the exact same question even these founders or promoters are thinking through, right? Because valuation is table stakes. You need to match the expectation and pretty much get there. And then the conversation is, do I see this as the right partner for me, or do I see the other, peer of Bain Capital as the right partner? What's their global linkage? What can they do for us? And so every time we look at a transaction, the first question we're trying to ask is, how are we going to win this, and why do we have the right to win it? And if you don't, then you should not be playing. Right? So
I guess it's really a complex environment. On the one hand, it's more than just price, which determines success to deals. On the other hand, it seems challenges and opportunities in today's time are two sides of the same coin. So I guess very difficult environment ahead, I guess, in deal making, given all of the global headwinds. Let's move to another very relevant topic, Kapil, for today, and that's ESG. And certain global financial institutions have recently faced regulatory scrutiny for non-compliance or absence of ESG controls. SEBI is also considering ESG compliance for private pools of capital. Can you walk us through the ESG process while evaluating investment opportunities? And do you have a separate vertical that does ESG risk analysis? And how do you really price ESG compliance in your deals?
Yeah, thanks. Very pertinent question. We have a global team headed by a friend of mine, Megan Starr, and she has a dedicated team with regional people. So our EMEA head of ESG kind of visits India very regularly, works and interacts with our portfolio companies to drive their ESG initiatives. It is a part of our diligence process, right at the start, before we even get a deal done. And we kind of assess what's the current state of ESG, and also what we want to do during our ownership. And our system is not just satisfied with meeting the regulatory requirements. What we want to do is that to be the best in class from an ESG perspective, in our sector. So we do track it very regularly. It is part of our board reporting and part of evaluation metrics for our senior management. So we do that. Just as an example, we invested in a data center business with a very large partner in India, and both our partner and us, we had a very strong ESG roadmap when we came in, and we have a clear net zero emission target. It's part of CEO's KRAs, and I'm glad to report that the share of renewable power that we use is amongst the highest in the industry already in India. And we were able to bring these best practices because we have owned data center businesses in US and Europe. So we really had a ready playbook to say that this is what we need to do as we expand this business. And we only partner with people who kind of align on these philosophies. To Manisha's point, the governance and the alignment with the partner is very important. So, so that we have no challenges in implementation during our hold period. So we were glad to find a partner who was really high quality and was completely aligned. But would let Manisha and Sahil add, I'm sure they would have seen it differently in other organizations.
Yeah, I think, I just want to endorse what Kapil said. Last year, we advised BlackRock on an investment in Tata Power in the renewables business. And as Kapil said, I think this was a driving criteria for them. We actually evaluated a lot of opportunities for them. As you know, BlackRock on the private side, I agree, doesn't exist. This was their first investment. They've done public market investments, but basically all their private investments have been in China. So this was the first time they were coming into India, and this was one of the key criteria that was basically evaluated by them for investment. As you can well imagine, there were a lot of companies which were wanting to get BlackRock on its table or its cap table, but this was the criteria that really pivoted the transaction towards Tata's, or because Tata's demonstrated a clear partnership on route to the whole ESG area, and I think it is the overriding criteria, and the large high quality companies get it. They get the fact that to attract global capital, they need to demonstrate their commitment to ESG net zero, and those are the ones that are having premium outcomes on valuation to those companies. So, and that trend will continue in the next few years.
Yeah, I totally agree with that. I think the last point Manisha made, I think, is the other critical point. Right? I think down the line, companies that have a focus on ESG are actually thinking through those will get a premium valuation because investors, I mean, again, going back to the fundraising I was talking about earlier, that is like, again, in that list of questions, that's like the first or second question that, LPs ask you, right? What's your ESG sort of, how do you look at things from an ESG perspective? How do you evaluate this? What are changes you guys have made in your portfolio companies to drive ESG initiatives? So I think, it will lead to premium outcomes if you get it right.
Very helpful, and to get this deep insight from each one of you. Sahil, let's look at the exit side now. India witnessed a number of, either lackluster IPOs or a sharp drop in listing price, post IPO. SEBI seems to have gotten involved in the valuation discussions. What is your point of view on this? And do you see the environment getting more robust with investors spending a lot more time in pre-IPO processes, in particular around valuations? And a linked question: how's your experience been on exits from India generally and taking out capital from the country?
Yeah. So I think there's definitely, I would say, a few positives with the IPOs that took place over the last, let's say, 24 months, and then of course a few considerations or issues to address. The positive in my view is that I don't think prior to 2020 most of the tech or loss-making companies would have even thought about being able to list their businesses in India, right? So the fact that while we can argue about what valuations were and what these things came out at, but the fact is that you had a slew of these companies that actually have listed and continue to trade at what I think are not, even after the 50-70% correction, Zomato still trades at 4 times revenue, forward revenue, it's loss making. A Policy Bazaar trades at 7 times. Even delivery, which is, I would say, more logistics, less, I would say, tech trades at like 3 times revenue, right? So there is the good thing is there is a place for these companies in the Indian markets, and people are willing to give you valuations if they think there is a good story, there is something that that they can generate returns from, right? So I think the positive was that there is an outcome that can be created. I think that being said, there is of course a lot more focus around valuation today, right? So I'm not I don't have a view on how SEBI thinks about this, but I can tell you that at least investors spend a lot more time around what valuations a company like these can get when you go to exit. You have a listed universe, you have of course transactions that may have happened since then in the market, and so you have a much more robust view of what you can get to at exit, and hence people are baking that into their sort of their entry valuation. I think like in most other things in India, I mean, something these things will go through its own phase of maturity, so you will have some of these hiccups along the way, but eventually everybody will be better off through time as these companies come, more of these companies come to the market and there is a level of maturity. I think how SEBI deals with it is out of at least my understanding. We'll have to see how they look at it from a regulatory and minority shareholder perspective, but I think there are some positives in the fact that those companies listed. I think on your second part of the question about exits in India, I think having looked at this for the last 15 years, I think India has gotten there is a sense of deepening, right? I mean, it's you can see that in just I mean, look at just this morning, Blackstone was able to sell a 20% stake, 5,000 crore in Sona Comstar. KKR was able to sell their 27% stake, again 9,000 crore plus transaction in Max Healthcare. Blackstone did the same thing in SL a couple of years back, again 20% plus. So these outcomes were unheard of, right? Even 5 years ago, I think nobody would have been. We would have pages, and maybe Kapil can also. We would have pages in our IC memos talking about you can exit these 60% positions in India, and you would have some one transaction that you could show that somebody had done. Now I mean, I'm giving you an example from today, right? So I think a lot of the questions in these IC conversations are, what used to be, listen, can you ever get out of a 60% stake is less of a question today. I mean, there's of course considerations, but I think the market has gotten to a stage where you can, for the right company, of course, at the right valuation, right quality of team, you can get out, in a reasonable 4 to 6 year type of period that would not have been easier before. Again, that being said, I mean, there is still a long way for India to go, right? I mean, it's not as easy as it is in developed markets. I mean, I can, when we were at Temasek, when we were invested along with Advent and Crompton Consumer, it did take a couple of tranches for us to get out of it. So it's not that everything is easy to do, but it is getting better. Again, that being said, India, as always, there are regulatory things. I mean, there are issues around lock-ins, your ability to freely distribute dividends, as you pointed out, leverage. You can't do a leverage buyout. So there are some of those things, but I think overall, my view is that it has gotten better.
I think just to add, Sahil, to your point, I think this is the area that India's matured the most, the exits really. I agree, when you and I started our careers 20, 25 years ago, if we went to pitch to Kapil and Sahil, what's the exit? We would, point some 4, 5 mythical global strategics, which we thought would come one day to India and say, no, come on, you should do this. And, X Abbott will come and buy this or something like that. It's no longer the case. As Sahil said, the public markets are deep enough to absorb large blocks, whether it's a Max KKR or the morning trade that Sahil mentioned about. The other thing I agree is really the alternate pools of capital, right? The sovereign wealth funds and the pension funds, which are coming in size, right? We've heard about the Temasek Manipal deal where, you saw CPPI take a controlling stake in Renew, right? That doesn't happen. We were not programmed to sovereign funds and pension funds coming and taking controlling stakes, and that's happening. An exit on Renew, one would have always just thought about the fact that either they'll just keep peddling it out in the public markets, or maybe some strategic will come. So I think what's really heartening for me as a banker is that you have also you have the strategic, but you have the sovereign, them from different geographies: Canada, Singapore, ASEC, and GIC. Yeah, and I want to do it in size. When we did I agree with you, the Reliance InvIT trade, it was $1 billion trade. PIF, which was a first-time investor in India, took a $500 million entity along with RDR, ethical risk too. So the exit route.
Yeah, and Kapil, how would you compare this with other emerging economies? As a global fund operating in so many parts of the world.
I think it depends on the quality of the asset. To echo what Sahil and Manisha said, I personally was involved in SBI Card and SBI Life exit of Carlyle. These are high quality companies, very well run, and very well traded in the Indian markets. So the exit liquidity discounts, etc., were very much comparable to US, and in fact, in few cases, much sharper than US. So we did not have to bear very high costs for those trades. And hence, in many ways, they are significantly better than Indian capital markets than many emerging markets, including even China, which is a large market but doesn't have as good an exit mechanism. Hong Kong, in its heydays, used to be equally comparable. But obviously, Southeast Asia doesn't have anything like that. LATAM doesn't have anything like that. So I would say India is now almost in the league of developed markets in terms of liquidity, and that's a big change, because that allows us to do large deals, exit large deals. Sahil talked about some of them that our peers have done, but as I said, we ourselves have seen that it's a very large market, and you can sell very substantial position across tranches. But if it's a good, well-performing company, the markets continue to have and be hungry for more. So that's how we saw it in SBI Cards.
Okay, so thank you very much for that. Bharat, over to you now on a different topic: shareholder activism. Shareholder activism seems to be very active in India. In this context, proxy advisors are sharing their views on an array of issues. Does potential views of proxy advisors play a factor while making critical decisions?
Yeah, thanks for that question, Hagreev. I think really pertinent in the context of advising on transactions. I mean, is it a factor? Clearly it is. Very often, as they say, exceptions make the norm. And we're all aware of, various transactions where, for example, shareholders have rejected the reappointment of certain MDs who've sought substantial pay hikes as compared to what is arm's length in, pandemic hit years, and only later, allowed the reappointment when caps were placed on their salaries. There have been purported delistings where proxy advisory firms have given guidance in terms of what should the reverse book build price really look at as compared to what was floor, and those have influenced the market. So clearly, proxy advisory firms in some sense can be weaponized, if I could use that. In some circumstances, either before the regulator or before the media, to really put pressure on management. So that's at the other extreme end of the spectrum. And I think, very often in, some ways of measures of success is, does regulation step in? And the fact that, SEBI is, I think a couple of years ago stepped in through the 2020 procedural guidelines for proxy advisors, to regulate the dialectic, if you like, between sharing of reports with their clients and the companies simultaneously, allowing the companies to really comment and to make corrections, and then to disseminate that back to their clients, is all reflective of the much deeper and mature markets that that the panel has already alluded to. So certainly a critical factor and one that will, I think, continue to be important.
Seems, when we have all these proxy advisors reports, it's looked at initially very negatively, but I think they are playing such a deep and great role in terms of governance and other matters. And what you say is so right in how much those reports are looked at in deal making. So thank you for that. Akash, coming to you, as transaction lawyers, we are perhaps the last bottleneck, so as to speak, for an investment. So, in your experience, has there been significant changes in which, the way transactions are done and approached by financial sponsors as they were being done, say, on the sales side, as 10 years ago to now? What have you seen as significant changes?
No, absolutely, I agree. First of all, I must confess that it is really tough to be liked in a room where the investment thesis is set. Manisha wants the deal closure. The investment committee has approved the transaction. So both Sahil and Kapil are motivated to, get it done. And all that is sitting between the investors and entrepreneurs are us lawyers. But on a more serious note, I feel that right-minded advisors, whether it's accountants, tax advisors, or lawyers, do add a lot of value to transaction. Coming back to your question, I'm sure that my fellow panelists will agree that there has been tremendous change in the way transactions are approached now. There are some positives and there are some, I would say, so to speak, drawbacks. Just thinking aloud, I would put it in three broad buckets. One, I would say, is availability of data and clarity. Now, the way the data and technology is impacting transactions now, it has never did before. Even before we start on a transaction, there is enormous clarity from the investors on what truly matters. Of course, there are occasional surprises, but on an overall basis, a team of investor or sellers and the respective advisors are a lot more laser focused today than they were, say, about a decade back. A lot of work is done today, and at times, or most of the times, risk allocation happens even before transactions are formally initiated. And I would say, for me, that touch point is when we as lawyers are today engaged. The number two to my mind would be something I would say, call it a regulatory loop. We're now today in a very interesting phase globally, where on one side regulators are saying we are easing up the regulations. However, day-to-day compliance is getting more rigid as decision making is on a delegated basis, often making it tougher. So yes, there has been an ease of a lot of regulations, but the cost and complexity of compliance has gone up tremendously. We did not have the nuances of antitrust regime 10 years back. Tax was a lot more simpler, and with every new financial crisis, the regulators starting from one end of the spectrum. Now, what is at times caught in between are genuine financial transactions. I don't, put the blame on regulators entirely. Look at what happened at FTX or what's happening at SPB for other reasons, not for fraudulent practices. And lastly, I agree. I would think that the advisor market maturity has also come a long way. I don't know how Manisha, Kapil, and Sahil view this, but my personal experience has been there is a lot more maturity and grounding on what's market on various, I would say, commercial and quasi legal issues. And we used to spend enormous amount of time negotiating every line of the agreement few years back. I'm not saying that those days are completely over, but yes, we've come a long way. There's a lot to be done, but there's movement in the right direction. And I just want to add a note, that as Khaitan and Company's private equity group, we are coming out with first of its kind market report on what's market in India for private equity, which will should be available with you all and with the larger audience soon. But yes, of course, there is a lot more movement to the positive.
That would be very
It's
interesting.
good to hear your positivity. Good. Let's hear from Kapil what he has to say.
No, I agree, and I think the processes have become more efficient. People have transacted more. There's a lot more history out here. Things are well set. I think that the country, the legal regulatory framework is also a lot more mature in some ways. But yes, I would be very keenly looking forward to that report because everybody has a different interpretation of what is market still. So that would be very good.
Yeah, depends on whether you're a seller or a buyer. So
True, true. Yeah. No, thank you for that. Coming to you, Manisha, can you give us some guidance and advice, both in terms of valuation and risk, while preparing a quality seller for a potential PE buyer? How do you really have initial conversations and then get the seller to plan, both on risk and valuation?
Thanks, I agree. I think it starts with the basics. You go in talking about the sector, how the sector stands in the company. That's the most important thing when investors like Sahil and Kapil look at a company. It's both bottom up and top down. They want to know whether the India has certain competitive advantages in those sectors, for example, pharma or IT services or consumer, because you're just playing on the Indian demographics. So A is just the sector analysis. B, within the sector, I think investors are very discerning, as we discussed earlier, on the quality of the company, the quality of the earnings, the growth potential, the quality of the founder. So that's the next level of discussion to be had, and that has to be a fairly authentic discussion, sometimes difficult too, because if the quality and the governance and the growth doesn't stack up, then the founder has to readjust himself to an outcome which should be pretty suboptimal compared to what he thinks of as his peers, which may be trading at premium multiples for exactly the reasons I articulated. So I think both those discussions need to be had. Based on that, we need to come up with a valuation. If it's a listed company, yes, there is a benchmark. If it isn't a listed company, then we need to have collated benchmarks, get the founder comfortable on that. It's very important we tick those boxes before we start a process, because otherwise you could just have a mismatch of expectations later, and that leads to a lot of pain. If you take a lot of times in the past, a lot of the sell side bankers have, especially for the public markets, have been really driven up valuations on desktop and led to the founder having such huge expectations that then the letting down of those expectations becomes a very painful process, and all of us get paid on outcome, right? And private equity too spends a lot of money when they're diligencing companies, so nobody wants to go into a situation where there is a huge mismatch of expectations. So I think if you're a good banker, that's the thing you must spend time on before you take on a mandate and launch a process, because every founder, especially if they're selling a company, they're very attached to the company. It's taken their hard work, sweat, years of hard work. So they obviously expect premium valuation. But I think it's important to have that discussion upfront in a smaller group with the founder, and only then launch the process. Because today, when private equity is spoiled for choice, they don't have to necessarily go after a asset. So it's important to, if I want to get the mind share of Sahil and Kapil, that I go in not only with a company that's good, but I'm able to convince them that it's at a valuation that is befitting to that company. Not shortchanging the founder, my client, at any point, but at the same time having an outcome where it's a win-win for both. So a lot of the effort needs to go into that. Second is just to ensure that we can provide the global outreach to investors, which we discussed. Haigreve, today come from very different geographies. So to get the best outcome for a company, you need to have access to strategics and private equity in the US, Europe. Till recently, till investments from China were allowed, even access in China. Gland had a great outcome from China, as you know. We were representing a company called IGT. It was Rahul Bhatia company, where the cover bid was from China. So basically, having a healthy competitive process leads to a good outcome. So two parts. One is the initial bid before the launch, where you really get the company ready on the aspects that I said. Second is when you launch, to ensure that you give your founder the best access that your firm can have across the world, so that you can then have a competitive process which leads to a good outcome. And that's really how we prepare a founder for the process, and then launch the process in a 3 to 5 months tight timeline to get the best outcome. long-winded processes, typically lead to deal fatigue, especially with private equity, which then moves on to the next deal. So you need to ensure also that the founder is clear on that, that the company is ready, that you don't launch a process and then you're half pregnant on that process, but you're not able to provide the kind of information that a private equity or a strategic investor wants. So all of that preparation, along with law firms like yourself, have to be done before you launch, so that then you're not leading to embarrassment later. And not just embarrassment, it affects valuation, because deal fatigue leads to people just down trading on value and saying, look, it's not a must-do deal. It then becomes an optional deal to do. Sahil and Kapil may have gone to the IC a couple of times. IC saying, look, what's going on? Why is there no outcome here? Everyone needs to move on to the next thing. Time is money for private equity and strategic investors. So yeah, a lot of the time goes in the prep phase, pre-launch, on both in the preparation of the company, expectation of the founders, and then run a tight timeline process to get a best outcome.
No, thank you for that. And Sahil and Kapil, you would really sort of be able to see through a well-run, process. And I think the time and energy you would devote to a well-run process, well-prepared, versus maybe something which is attractive but not well-run, well-prepared. How would you sort of compare the two?
Yeah, I think a well-run process makes it easy. I mean, so there's two elements to them. An attractive business, if you like the business, whether the process is well run or no, you'll figure out a way to sort of go after it. But I think a well-run process is one that will just make that easier, right? So I think time plays an important role for the guys that are selling here, and people would rather get things done earlier. So if your process is well run, people can get up to speed on the business faster, able to diligence it better, and then can get to a conclusion faster. If it's a bit of a haphazard process, that's just going to take longer, so the outcome takes more time. But I think when you form the view on attractiveness, you're going to take a shot at it, right? And you're going to go for it. Whether the process has been well done or no is secondary, I would say. I don't know, Kapil, if you have a different view.
No, I fully agree. But I would say when smart, experienced bankers like Manisha are running something, that lends credibility to the process in some ways, that the asset that is coming has gone through a level of check. So that draws your attention for sure. There are sectors and assets that we are tracking proactively. So even if it's not with a well-run process, there would be times that we'll proactively approach that and we'll try and create a deal. And we do invest a lot of time in those proprietary ideas, because if there's a business which is decent, and more importantly, I'm coming back to the point, are we the legit owner of that business? Can we do the operational transformation to make a leader out of that business? Because it might be a mediocre business today, but if we can bring in the right management, the right capital structure, the right M&A to make that work, we are not hostage to the process. A process lends credibility and efficiency, and probably brings more people like Sahil and me. So in some ways, an auction creates a competitive situation that allows the seller to have a good outcome. But from our perspective, even if there's not a well-run process, we are very happy to do prop deals. And a lot of times they take a lot of hard work, but we and our team are well geared to do that. So we end up doing both our job and part of Manisha's job, but that's life.
I'm very worried hearing all this, Kapil. You're destroying my sales.
I think we are worried too, because bankers and lawyers, we are being told are no longer needed. We can
Akash is going to release a template on standardized deals. Kapil and Sahil are going to do deals on their own. I give you time to go home.
Exactly.
To just make sure that they don't put money in some legal tech startup to standardize them.
ChatGPT will do the rest, so it's okay. It's time to go home.
Absolutely. Okay, so maybe let's move to the more interesting topic of some regulatory developments. I'll come to you, Kapil and Sahil, together. And can you share one or two regulatory developments or changes in Indian law regulations in recent years which you consider have helped deal making in India, from your perspective?
I would say two things. One, I think there are changes which have helped the economy in general, and if the economy and the businesses do well, we all will do well. There's a lot of data that initially Akash was talking about. So for example, if there's a consumer business today and the whole of cashless economy and the UPI data and the digital tracking and the marketing data makes it so much easier to underwrite. India has probably the best UPI framework, the payments framework. The whole of GST framework has helped because you can really do your diligence very efficiently. And it has helped a lot of organized businesses, higher governance businesses grow and succeed and emerge as market leaders. So I think those changes are quite good. I would say Indian regulators in general, people like RBI and SEBI have been very good. They have been risk conscious, but they have put in the right foundations, and we really like that. And gradually they have relaxed some of the norms. For example, IRDA relaxed the insurance, foreign shareholding norms and things like that. So I personally think that we have done well on that front.
Yeah, I agree with that. I think maybe just two things I would add. I mean, this regulation, I guess, this is a SEBI. We were talking about takeover and delisting. I think this Blackstone R Systems transaction is one interesting one to see how that plays out, because it's, so far it's been very difficult to go and delist a business, right, and to effect a takeover in that way. So I think we'll see how that plays out. But that to me is again one sign that things are evolving. We'll see how it works for them. I think the second one is, while I don't think it's it's not a regulation just yet, but just the consultation around having private equity as a sponsor in the mutual funds plus the insurance thing Kapil just mentioned. I think those are again steps in the right direction. We were impacted when we were looking at IIFL Wealth because they have a mutual fund business where you could not, as private equity, be a sponsor, right? So I think those are positives in my view.
No, thank you for that. So we are coming to the end of our session. I'll take one more question, and then we have lots of questions from the audience, and then we'll move to some audience questions. So Manisha and Sahil, can you pick two sectors which you consider which have the most potential for investment in India in the next 3 to 5 years, let's say?
Sahil, you want to go first?
Sure. I'm just going to pick a sector that I cover. Now, people can take their own view on it, but I think industrials, which is a sector I cover, doesn't get enough love, or hasn't, at least historically. I think, and there were reasons for it, right? I mean, it's not manufacturing is not an easy space to invest in. There's cyclicality. A lot of Indian businesses so far hadn't scaled. You'll see a lot of people in a certain size bucket, but not, beyond a certain level, low value add. But I think, when we see the last, let's again call it 12, 24 months, there has been, some, both a combination of what's happening from a geopolitical and macro standpoint. So, China +1, Europe +1, plus India taking certain steps, right? So the entire PLI scheme, I mean, if you look at, on the auto component side, it's a $3 billion PLI scheme, right? On chemicals, it's $2.5 billion. It's 40,000 crores on the electronic manufacturing. So I think all of these are steps in the right direction to make industrials, in my view, an interesting space to look at. And we have been spending time in all of these, areas that I just called out. Time will tell whether we get the right opportunities there. But I think industrials is an area that at least I would call out as an interesting sector.
Just to add, I think first, I agree, in the next 3 decades, 22% of the incremental working population is going to come from India. So that is going to lead to increased purchasing power at the hand of Indians. And to that extent, consumer healthcare services, pharma, which plays to the domestic market, is a sector that I'm very, very positive on. Valuations are not cheap in this sector, especially for quality assets that Kapil mentioned earlier. But I still remain very positive because adjusted for growth, I think just playing on the Indian consumer and the Indian demographics can't go wrong. Second, the sector I like a lot is infrastructure. I think there's a lot of capital coming in there. The digitization of logistics that India has done, whether it's GST or FASTag, e-tag, etc., will lead to such an incremental boost to the GDP. And I think that segment is another segment where investment opportunities can be can be plenty and can actually lead to multiple turns on valuation. So those would be my favorite sectors.
Kapil, what about you? You have any favorites?
I think it's well covered, but I would say financial services is a good proxy of the Indian overall economic growth. We have done well in that sector, and I think that sector will continue to do well because of the reasons that Manisha mentioned. The demographics helped, and the overall GDP will kind of do that. And I also cover IT services. I think we are already, as Manisha was earlier saying, office of the world, and I think every business globally will continually have a need to have a digital transformation, whether we talk about AI bots doing legal work or chat GPT. But for all of that, you will need IT services and talent. And a lot of this 22% of the workforce coming to India will do that tech transformation sitting here in this country for the entire world. So I am quite positive on financial services and technology in that sense.
So looks like still good days ahead, lots of good sectors for the country. So
I think we covered every sector out there, right, in the responses. So.
Good to have different favorites. People.
Yeah, exactly. I think the point being that it does in a sweet spot. I think I agree. As you can see, the three of us had three very different sectors, but
correct.
The point being that if we are in a good spot, we just need to, as you said, provide regulatory certainty, government continuity, and continue to keep the focus on governance, ESG, and I think we'll be home. We'll benefit enormously from the last 10 years of pain and structural reforms that we've gone through. And each one of us can have different sectors we like, but I think the outcome is going to be favorable for in the next 10 years for India.
Fantastic. So we have lots of audience questions. Let me take a few, and given that we have now about 10 minutes for audience questions. So I'll take the first one, which is from Ashwin Mohan at Network 18. He says that considering global headwinds and India being seen as a bright spot, why is it that the likes of Carlyle and Bain, who are super bullish on India, have shied away from launching India-specific funds rather than relying on Asia funds? Is it because the LPs think India isn't that large a market? So that's a question for the two of you, Sahil and Kapil.
I would say India is a large market, but from an LP's perspective, it's great to have diversification and not be bound to a country, because funds are for 10 years, 20 years, right? And we have done really well in terms of picking the right spots across the region. So we have always had an Asia fund for the last 25 years. We are probably one of the first global firms to have Asia dedicated platforms, like way back in '98, if I'm not wrong. So I think we will continue with that path, and that has worked very well for us as an organization.
I also think there's a benefit to having an Asia platform. We are an integrated team, right? So, I was on a call today with the management where my colleagues from China and I were on this call together. The business has, an India element, a Southeast Asia element, and a China element, right? So if you're looking at it purely from a India lens, you may not have that integrated opportunity to look at something from an Asia lens, or even we do. I mean, when we look at IT services, for example, our US team is also, pulled in. So I think there's one element of where you're raising your funds, but I think we also have, at least as Bain Capital, the view is we're a global integrated team, and hence we prefer sort of this regional approach to funds as opposed to just, a domestic India.
Right. No, thanks. That's very useful. And I guess the same would apply for other emerging economies where you perhaps don't have dedicated funds. I'm assuming for countries like other developing markets, and you could have regional funds, and that could be the same.
At least at Bain we don't. Yeah, we have North America, or Americas, Europe, and Asia. I think Japan is the only one where we have a mid-market fund, but that's very different market. So.
Right. And Haigreve, just to quickly add, when we pitch on the sell side, a lot of the founders actually want an outcome with the likes of Bain and Carlyle, etc., for exactly the reasons that were articulated, that they want their global network. If you're an IT services company, you want access to the global clients that a Carlyle or a Bain brings. So actually, it works to their advantage. Having said that, of course, just pure domestic funds like Chris Cap, multiples, etc., Kedara are doing very well. So if people want to play just a domestic fund, the LPs can go through that. But in my sell side pitch, I think the global perspective that a private equity brings is actually seen as a positive by the founder today, just because of how globally integrated businesses are.
Right. No, I think that's great perspective, and often, there's a misunderstanding that global PE funds don't have dedicated India funds, but I think there are solid reasons behind it, and not just because they don't have the confidence on India. So we'll take our next question, actually two which have come from Alvin Selvam at Brookfield. And his first question is, given that PE investments are all about underwriting risk, how does the panel underwrite, if at all, the geopolitical risk in the context of India? So, I'll throw it open if anybody has views on how to underwrite geopolitical risk in India.
It's a interesting one. I'll take a shot, and I would say, for example, anything which is with the countries which are on sanctioned list, we would shy away from being a US firm. So those kind of geopolitical risks we just don't take. We think that India is a market where consumption, which Manisha was talking about, is a long-term theme. So even though there may be some geopolitical changes in the short term, in the long term, I think the country is well poised for a secular growth. And we don't have an ability to kind of price it. Let's say, for example, if something has a lot of any enemy country exposure, we will not spend time on that. So we don't have an ability to circumvent those risks. If we can't be the rightful owner to be able to underwrite those risks, we'll look forward to the next opportunity, honestly.
I think the pendulum swung the other way on this. I agree to Kapil's point. From time 15 years ago, when geopolitical risks on India was seen an all-time high, we're actually seen as a haven, given just what's happening in Europe, given what's happening in US and China, on Taiwan, etc. So, in the kind of stability that we provided in the last 10 years, I think we are coming out as a positive in this area.
Yeah, I was just about to say that actually. I think from a geopolitical standpoint, if you look at India, we've kind of, I mean, you can see what's happening with Russia, Ukraine. We are the largest, acquirers of oil from Russia, and that hasn't raised much concern. At least I haven't seen it raise much concern, with the developed market like US or Europe. So somehow we seem to be in a somewhat of a sweet spot geopolitically, and less. I mean, LPs. I mean, this is not a question that has come from any LP to us. Right? How do you view a lot of questions on China, a lot of questions around how we think about China, but very limited around India.
Thanks for that. We have another question from Alvin for you, Akash. In your view, how has the PE sell-side deal-making environment evolved or matured in India? And for example, is the market purchaser pool receptive of the end of life issues for a PE seller? And have insurance products lived up to their expectation?
Yeah, thanks, Agreed, and thanks, Alvin, for asking the question. I think that side of market is evolving as more and more funds would come to end of the life cycle. A lot of investments that have happened in 2007-8 are the vintage where the fund life cycles are coming to an end. And there I would say that there are two sets of buyers. One set of buyer is who's sophisticated and who has seen end of fund life issues across the globe, who appreciate the limitations which a financial seller would have operationally, whether it can back warranties, whether it can give coverage. And the second set of buyer would be who's new to this whole separate ecosystem of financial investors. So number one, where somebody has seen it globally, would be a far more receptive. They also acknowledge the value that has been created with private equity ownership, which is extremely different from an ownership of a family. And I'm not saying that there's a good or bad, but private equity ownership is completely different in the way businesses are set up and run. So that is one. And the second is on the insurance side. I think today there are a number of products which are available. Yes, one can see what the costs are, how premium is allocated, how the differential is allocated between the parties. But then today, that insurance coverage market has also evolved significantly to give comfort to the buyer and the seller to make sure that such risks are properly allocated and taken care of.
Thanks, Akash. Then I have a question specifically asked by Jaychandran Nair for you, Bharat. And he says, this is a question for Bharat. Bharat, do you see LBO being allowed by the regulators soon?
I think this topic came up on the panel as well. That this is one of those areas where we're looking at regulatory reform. I think personally, given the discussions that have happened on the availability of leverage, rising interest rates, etc., and the India story that we're accustomed to this high inflation, a relatively high interest rate domain. The fact that you've now got much deeper markets. And changes like Caro, etc., which have brought about better governance. I think we're clearly maturing, and therefore there is no reason why we should still have the norms of earlier. So hopefully with inputs from a panel like this and my co-panelists, hopefully the regulators listening, and we will have impact.
Well, thank you for that, Bharat. Then I think we have, I think we'll take one last audience question. And so this is a question which says, as a young and aspirational PE professional in the audience, can you recommend one book that every investment professional and person interested in private equity should read? And this is actually addressed to each of you, Manisha, Kapil, and Sahil. So maybe they should just follow you, but I think they also want to read a book. So if you can recommend something.
I would recommend a little dated book, which is Barbarians at the Gate, to get a little bit of a good perspective on how quick and smart the thinking on the part of private equity is and how they actually do transactions. So it's written like a thriller, so it's very interesting, and I would highly recommend it. But that's a bit dated. Maybe Sahil and Kapil can give a little more recent recommendations.
I was actually about to recommend an even more dated book, which is The Intelligent Investor.
Yeah, that's a good one.
That's what he's somewhere in like the 1940s or something, from what I remember. But while it's a bit dry and it can get a bit long, I think it still holds true if you want to be a value investor, someone that can sort of really look at businesses in a particular way that, at least I think, in what we do is truly helpful. So that's at least the book that I think I would recommend.
Obviously, old is gold. Yeah. So, but over to you, Kapil.
Yeah, they're now validating for you and me, Haigreve, after having beaten us up now.
I would recommend a book called The Outsider. It's about how 12 US CEOs created value, because I think it's about a long-term value creation. And while it's not written from a private equity perspective, honestly, our business is about backing the CEOs to create the right value. And a good metric for determining a CEO performance is value creation, stock price appreciation. So it's written in that manner, and one of the CEOs covered is Warren Buffett. So one can get a lot of perspective in that.
Thank you. So I think that is really bringing us to an end of our webinar. And Akash, can I ask you to give us the key takeaways from today's webinar that you think are pertinent to recent trends in private equity M&A?
Sure, I agree, and thank you for that. I would try to take, to give the takeaways and also add one or two bits that I have in mind. So, thank you everyone for an extremely insightful round of discussions. I personally learned a lot from all of you, and I'm quite confident that it holds equally true for the audience at large. So I think some of the things, number one, I think beginning of our discussion, quite clear that India as a market has matured and deepened, and keeping global economic headwinds and volatility aside, it will continue to have its share of opportunities. And somewhere during the discussions we had, the strong exit prospect also reinforces this confidence. I think there was a common ground that private equity as an asset class will become more dominant as a source of capital to turn India's growth engine even forward even faster. And we do expect a lot more deployment. Say that the private pool of capital has become even more wider, so it's not limited to private equity. It starts from venture capital to the growth equity to buyout firms like Carlyle and Bain, and then we come to special situations, private credit, and impact investment. So you see how deep this market is and what it could do for economy at large. Quality assets and focus sectors will continue to be picked for the investors: consumer, healthcare, IT services, pharma, infra, logistics, industrials, financial services are to name a few. And as Kapil mentioned during his discussion, empirically, private capital has created a lot more jobs, improved quality of products and services, and created more opportunities. So we're hoping for some reforms. Especially like the one which Sahil mentioned about permitting sponsors, private equity to be sponsor for mutual funds, among other spate of reforms. One more reform that ideally would come, could possibly can help is new fresh instrument or thinking through instrument which can help both entrepreneurs and GPs like the ones we have on the call to bridge valuation gaps. It's quite common that comes across in every transaction on how to bridge the valuation gaps, and we go through very complicated process to achieve some of those structures. And I would say lastly, two more things. One is governance will take center stage, and significant value will be attributed to companies that are high on ESG indicators. And my last point is listening to the points around shareholder activism. I think private equity will also lead the way for being responsible investing, so to speak. That will assuage concerns about shareholder activism, and will also pave way for a stronger entrepreneurial India. So that's I think my takeaways, Harpreet.
Oh, thank you, Akash. Very thought-provoking and very insightful. Thank you very much. Mitesh, maybe we can have the poll slide now. Before closing, I would like to ask each one of you in the audience to respond to the poll slide on your screen and to provide your feedback on today's webinar. We take this very seriously as part of our continuous improvement program. Finally, I would like to thank each one of our guests for sharing their experience and expertise with us today. Manisha, Sahil, and Kapil, thank you very much. Without you, this webinar would not have been possible. You each did an outstanding job, and we are very much indebted to you. To our audience, I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. After the webinar, we will send you a copy of today's presentation materials, summary notes, and a link to the webinar recording. You will also separately receive a request for your feedback on the webinar. Please take the time to give us your feedback, comments, criticism, and even compliments. The form takes less than a minute to complete. Please do not hesitate to contact us regarding the matters arising from the webinars. Our contact information is on the contact slide at the bottom of the webinar. Thank you for the audience, and we look forward to being of service at future occasions. Thank you.
Thank you so much.
Thank you.
Thanks, everyone. Thank you, Manisha.
Thank you. Bye, everyone.